Hello, dosto. Welcome to Desi Investors. And today's topic is fund manager raised stake in 194 stock in December quarter. Is it good idea to follow them? So it is an interesting article written by Kshitij Anand. If which states that what fund managers are doing even at the stage of bear market. Fund managers raise stake in as many as 194 companies. So this can be a very interesting point because the bear market which started in January 2018 have been very painful for a lot of investors which just moved them out of the market. Now they think, now the big guys, the fund managers are really looking for an opportunity to get bargains. So this is one of the main aspect of investing is to choose the right moment to own the stock. So fund managers have added 194 companies in the December quarter. Stocks of these companies have fallen up to 70%. So this is one of the interesting lessons for investing. So they have picked up the companies which have been fallen by 70%. So when is good time to buy a stock? That is the most difficult call when investing in stock market, especially when a stock is falling. Experts have suggested that if a good quality stock is taking a hit due to external factors, investors should use dips to buy for long-term potential growth. Stocks in which fund managers have increased their stake in the December quarter include Ashok Buildcon, NCC, KNR Construction, Orient Cement, Dixon Technologies, Apollo Tyres, Forgings, PEML, Ahluwalia Contracts and Solar Industries. As of data collected on January 21. On the contrary, fund managers decreased their stake in 117 companies including Bharat Financial, Atul, MCX, Divis Laboratories, Aurobindo Pharma, Atul Auto, CL Educate, Raymond, Manpasand Beverages and Irvin. So these stocks actually corrected very sharply. Even in the case of Manpasand Beverages, there was even a fraud. Not fraud, but there were some allegations regarding how they maintain their books of accounts. The next big question is, should investors look at stocks which are part of mutual fund managers list, considering the fact they are known to be experts? Well, most analysts suggest investors to avoid following fund managers blindly and instead do their own research before putting money. Key variables such as risk profile, investment horizon, as well as portfolio holding will be different for every fund, and there is a low probability that retail investor will be able to match that. So what that means is that fund managers have their generally buy for long term, maybe 5 years, maybe 10 years, depending upon their requirements of the fund, and they also doesn't care much about the daily fluctuations in the prices of the stocks. So that can be a big hiccup because the retail investors generally get discouraged or feels that they should sell their stock when the prices are falling. So retail investor for investor it would be difficult to the match the fund manager. So we should take into account these factors before making a decision. Retail investors and like venture fund. So that's all for the day. Thank you. Bye bye.